Hello. How's everyone tonight? Everybody doing good? We're doing okay, huh? That's good. Um, I hope, I'm not sure because people who are in my class seem to have not gotten the emails with the links, but yet there's other people who are getting links. I have a Bailey online. Bailey, can you tell me what chapter you're working on this week? Okay, how about, hi Amanda, it looks like you made it. I have a Terry A online. Terry, can you tell me what chapter you're working on? You're working on chapter 5. All right. I need to get a feel because I still know at least a couple of classes that are on different lessons, and I just want to make sure that if we have some people who are already moving on to chapter 6, that I take the time to answer those questions as well. Okay. So Melinda didn't get an email till a few minutes ago. Doing okay. Okay, let me try to touch some bases on signing up for these webinars now. As those of you who are in my class, Bailey's on chapter 5. Okay. Those of you who are in one of my classes, I originally was just sending you the link, and then when this became open to all Accounting 101 students across the state, it is something that is sent directly from central office. So let me see real quick here. We'll view my email over here. And here's the things that I was getting. I got a reminder to me at an hour before, and this is just an example of one person's response. So whoever Lisa is would have gotten this email at 8 o'clock approximately, and this is a unique number to her, and that's those students in my class. I've posted this instead of the link straight to the webinar, and that's why you were getting blocked out. And then if you hear of other students in your classes that tried to get in and didn't, then you can share this information with them. And then I'm just pretty sure, and as you can see, I get lots of emails, so I saw a reminder yesterday, I thought. So last night, people should have gotten one, and these emails are coming from customer care GoToWebinar. That's who the email would come from. So maybe that is going to your junk mail or something. But if you have registered, everyone's going to get that information. And then for me to help you to know where to go to register, there was a link sent, because I didn't know this, and I was asking this question of you all last week, and we weren't getting very far with this. So I do have an answer to that, and I'll want to see how many of you got this. Terry, you're on chapter 1. Are you in a 12-week class? Ah, we have a newbie. Is anyone else in a 12-week class? Okay, I had asked the question, had to remember where I filed this. I had asked a question last week at how you guys were being notified about this and how the people, from across the state were being notified. And this is an email sent back out from central office to me saying that the way that you actually get to the website to register is this link here, the www.ivtech.edu/online/livesessions.html. And that's just a site on the Ivy Tech homepage. I did not see a link. It's not really a link that everyone can get to, but you guys can get to it from this link. I can post this in my class, and then I probably could send it to the statewide chair and they could send it, but you should have gotten this email. I'm not sure when this email went out, but everyone should have received this. And that is the link that you go in. So does anybody remember? Oh, I'm bouncing around. I'll try, Amanda. I keep jerking my head around. So did everybody get this email, or do you remember getting this email? It's probably been a couple of weeks ago. Well, that's really interesting. So maybe everyone except the students in my classes got it, which would be extremely odd, but I will track that down and try to figure out what's going on with that, because maybe if my two classes aren't getting it, maybe everyone isn't getting it, and maybe I can have them send that out again as well. Okay, so do I have anybody here tonight who is already to Chapter 6? It's my fault, Shad. It's probably my fault because I had posted the wrong link in your class. So we've been just talking about how you actually get to the sessions to sign up. And what I have on the screen right now, this web address will get you there. I can send this back out to the students in my classes, and I can also talk to them at central office and see why so many people didn't seem to get this. Okay, so I don't seem to have anybody reporting in who say they're on Chapter 6. And Terry, with you on Chapter 1, we're going to be a ways ahead of you, but I go back and you're right. You're right, Amanda. We're on Chapter 5. My classes are on Chapter 5. I just know that there are some students who are on Chapter 6 in some classes, and that's why I'm checking. I just want to make sure no one's here tonight on Chapter 6, and then we just won't talk about Chapter 6 yet. Okay. But if somebody's here from Chapter 6, I want to try to touch base because that's an inventory chapter, and it's something we'll want to work on. Okay? Okay, so we all have an idea of where to go to register, know to watch for an email coming through, and then you register for these seminars, and once you're registered, then it starts sending you those reminder emails, and it's sending you a unique login with that, or a unique page to go to with that, and that's then how you're going to be able to get in to see those in YouTube if you want to go out and watch them in YouTube. see who other new faces we have here tonight. I want to welcome you, Terry. And like I say, we'll do a lot of going back and covering the concepts, and you'll learn a lot. We just may be ahead of you, but you'll catch up pretty quickly. Is it Tanuia? Tanuia? I'm butchering your name, I know. Okay, Amanda. We'll figure it out. And we've got Bailey here. And Bailey, you said you were on chapter, I got to scroll back up, chapter 5. Okay, let's just take off and talk about chapter 5. And then if anyone joins that have specific questions about other chapters, we'll get on there. Let me just do a quick, I'm going to just pop back to my little rules of accounting here real quick. And I'm going to do that somewhat for Terry's benefit, but somewhat just as a reminder for all of you that the rules of accounting never go away. We always have to learn or know that assets increase on the debit side. Did I say decrease? Assets increase on the debit side, decrease on the credit side. Liabilities react the opposite, increasing on the credit side. We use these rules when we are deciding whether to debit or credit an account when we're doing these types of journal entries. Then we post into the ledger account to get a total. From that, we actually then go and complete our first trial balance. We do our adjusting entries, post those, complete our adjusted trial entries or trial balance, and then we prepare our income statement and balance sheets. We're ready to close and we've completed the accounting cycle. It all falls back to these rules of accounting. Debit means left, credit means right. Remember that. Every transaction you have to have at least one debit and one credit. Your debits and credits must always equal in every transaction. And that's the basics. Okay, so let's start. I'll flip through PowerPoints. You'll have to tell me if these PowerPoints don't really work. If the PowerPoints don't work for you on the live. I know they just don't do very well at all on the when we're doing the playing back the recording, the PowerPoints don't do a very good job of moving along with the speed that I'm talking. And I know I do talk fast, but I don't think that's the whole thing. I think that it's something to do with the way that the program records. Okay. In Chapter 5, we talk about short-term investments and receivables. We want to make sure that we know that why companies might invest in other companies and what classifies them as a current asset as opposed to a long-term asset. If we want to classify as current, it's going to have to be it's got to be liquid, which means you can convert it to cash quickly, and the investor must intend to either convert it to cash within a year or current operating cycle, or use it to pay for a current liability. If it's not, doesn't fall into one of these categories, then it must be classified as a long-term investment, and that makes it a long-term asset. Investments in these securities are classified into 3 categories, and we did go through this real fast last week, but I wanted to highlight some of the things. We have trading securities, held to maturity securities, and available for sale securities. Trading securities are debts. They can be bonds, notes, etc. We'll talk more about bonds as we move further on in the book. There's a lot more intricacies in pricing your bonds and computing your bond interest than there is in just simple interest notes. And we can also have equity or stock transactions or investments purchased that we expect to sell within the next term, or we just trade them. People play in the stock market. Let me back up here. I'm really fighting with my computer. Okay, some of the reasons to invest in other companies, we may want to, well, I already did that, didn't I? Let me get going here. Okay, let's look at this trading securities transaction. Remember, we always would want to apply the rules of accounting when we're doing this. We have to think about if we are buying stock and we purchase 5,000 shares of Intel stock as a trading security. We're going to assume that the stock is Apple's only short-term investment. So if Apple buys Intel stock during 2014 for $20 per share, paying $100,000 cash to Apple, or $100,000 cash, Apple records the purchases of the investment at cost. We need to think about what accounts we would use. Once we determine what accounts we would use, we need to determine if they are asset, liability, stockholders' equity. We need to determine what side they would increase on. Do they increase on the debit side? Do they increase on the credit side? Then we need to put our debit entry first to be in good form and our credit entry second. As we look at this, our investment will be our asset. Assets increase as we show on the rules of accounting. Assets increase on the debit side. Okay, so if we buy this stock, we have our investment in our trading securities for $100, and we paid cash for that. Again, cash is also an asset. Asset increases on the debit side and decreases on the credit side. Our accounting equation has to stay in balance for every transaction as well. If I have a 100,000 increase and 100,000 decrease, both on the asset side, that makes no change to the rest of the accounting equation. I stay in balance. If I receive a cash dividend on this trading security investment, how would I record that? If I get a cash dividend, what accounts would be affected? Well, if I get a cash dividend, I'm getting cash. If I get more cash, would that increase on the debit or credit side? Again, cash is an asset, which means it's going to increase on the debit side. And then what else did I get? I received a dividend. I received a cash dividend as income. Dividend revenue, $4,000. How do I know that my revenue has to be my credit? I know that because based on the rules of accounting, revenues increase on the credit side, and I now have more dividend revenue. That's an increase. We have to record unrealized gains and losses. Does anybody know the difference between a realized gain and an unrealized gain? Can somebody give me an answer? What's the difference in a realized or unrealized gain? I have a one no, they can't give me an answer. Right. Rebecca says that a realized gain loss is when it is sold, and that is correct. Now Amanda's hearing static. Is that when I touch it? Can you hear me now, Amanda? Is it bad for everyone? Okay, Amanda can't understand me at all. Everything seems to be plugged in pretty good. Okay, maybe it's better. Okay, I just tried to tighten my connection to my computer. I suppose I could have kicked it. Okay. Okay, let me know if this isn't better. So anyway, an unrealized gain. Okay, great. An unrealized gain is something that you may have heard of as a paper gain, or you may have heard people say, well, I had a paper loss, and that would be when the value of your investment goes down, but you didn't sell it, but you still adjust it on your books, okay? So you make that adjustment to record that the fair market value of that investment is less, but the actual the loss, the actual realized loss or realized gain does not happen until you sell the asset. So that's what we're looking at with this little slide here. It's talking about trading securities are reported on the balance sheet at the current fair market value. How do we make that happen? We record the unrealized gain or the unrealized loss when the value has decreased. The entry to make that happen here is a good example with, again, Apple Inc.'s. If their fiscal year ends on September 27th, does everybody know what a fiscal year is? I know it's something that is discussed in the very beginning of the book, but do you know what fiscal means? Okay. People say yes, they know what fiscal means, right? It's whatever 12-month period, basically. Yep, okay, we're all good on fiscal year. That's great. The more terminology we can understand, the easier this is as we move forward. So on this date, September 27th, we had a fair market value of Intel stock at $110,000. They adjusted that investment in Intel securities to its current fair market value with the following journal entry. Okay. Their value went up by $10,000, so they increased their asset account by $10,000. They have an unrealized gain of $10,000. The gain reacts like a revenue, increases on the credit side, right? Like a revenue here. And the investment is, of course, the asset. If we have a loss, we will reduce the trading securities with our credit to our asset account and record the loss, which behaves like an expense, increases on the debit side. Okay. Just simple transactions. When we actually do realize these gains or losses, when we actually sell, we would get cash for the selling of the stock. We no longer have the trading securities, which we left at the value of $105,000 from the beginning question. So do we have a gain or a loss now? Yep, we have a gain. Very good, Rebecca. And how do we know we have a gain? Well, we can think about this in many different ways. First of all, it is we're getting more cash than what the carrying value is. So of course that would be a gain. But we also have to make sure that our debits and credits equal. So we should be able to see by looking at this that we need a $2,000 entry on the credit side. So then again, if we know that a loss behaves like an expense and increases on the debit side, and a gain behaves like a revenue and increases on the credit side, we would find out or decide pretty quickly that our gain was what we are missing here. So when we have available for sale securities, the transactions are basically the same. We record the initial purchase, we record the dividend revenue, and we adjust them to their fair market value. The things that are different, however, are that unrealized gains and losses are reported as other comprehensive income, which is a little more complicated concept that we will learn more about a little bit later, but not tons in this class. And then we have accumulated and reported as accumulated other comprehensive income in the stockholders' equity. So here's an example of how you would report on the income statement. Balance sheet and income statement for each one. I'm going to flip through these slides. I'll go ahead and attach these slides, and you can flip through them, or if you want, with the notes attached to my class, at least, and that's who's mostly here. I want to get through so we can do a few problems. Okay, then we're going to talk a little bit about ethics and the current ratio. The current ratio is total current assets divided by total current liabilities. It helps to determine which liabilities we can pay, or how many times we can pay our current liabilities. Are we in good standing to be able to meet our liabilities as they come due? And when we start talking then about the ethics behind it, there are several ways that companies can increase their current ratio. Now, whether or not that's ethical, right? We have to think about that a little bit sometimes within companies, and it's the type of things that we need to look for if we're looking to invest. But there are some things that they can do that are ethical. They can launch a major sales effort, right? Have a lot of accounts receivables. If they have accounts receivables, that's going to make it look like, it's not going to make it look like they are going to have more current assets, and that would improve their current ratio. If they had money that they could pay off some of their, if they had cash sitting there and pay off some of their liabilities, that could help to improve the current ratio. And reclassifying investments as current assets. Unfortunately, might not be as good for the investors to be able to make a decision by, because if it's really not a current asset, then it would be hard to justify the reclassifying of that. Okay, as we talk about revenue recognition, this is not new either. We've talked about revenue recognition as we've gone through the book many times. We need to talk a little more about it. We need to talk about when do we recognize the revenue, and I did cover this a little bit last week too, I know, because we started talking about what FOB meant, and if anybody had ever seen terms on invoices, but I just feel like we went so fast and there's so much here that it's good to look at again. So revenue is recognized when the performance has been satisfied. So if I'm a service company, once I have provided the service. If I'm a sales company, it's when the goods have been delivered or the sale has been completed. And so there's several things. The goods have to be transferred, the price is fixed and determined, and collection is reasonably assured. The revenue is the cash value of the goods or services transferred, and these can be impacted by shipping terms and the payment incentives. So, and I know we looked at this too, but if we sold iPhones, then we have revenue, which is credited, and receivables, which is an asset, which is debited. We have more. Okay, and this is where we talked about the terms. FOB shipping point, again, and some of you answered me that last week, but we'll see if you have answers again this week. If it's FOB shipping point, who owns the merchandise as it's driving down the highway between the two businesses, between the seller and buyer? If it's shipping point, who does the inventory belong to when it's on the highway on the truck? If it's shipping point, the seller or the buyer? Yeah. Go ahead and everybody answer. I want to see how many we have. I have some buyers and I have some sellers. Okay. Hi, Katrina. I didn't notice you earlier. Okay. All right. If it's shipping point, as soon as it leaves the seller's dock, it belongs to the buyer. So several of you were right. So if it belongs to the buyer, as soon as it leaves the shipping point or the seller's dock, it belongs to the buyer on the highway. Destination is it would belong to the seller until it gets to the buyer's dock. Okay, and that means that's where you recognize the revenue. That's where you determine who needs to pay the insurance. It's how you determine whose inventory it is if you're needing to count inventory. Okay. And we talked a little bit about discounts last week too. Terms on an invoice, 2/10, common net 30. That would mean 2% discount if paid within 10 days. And net if due within 30 days. So if I had an invoice for $1,000, let's see if we can do this real quick. if I had an invoice that was $1,000 and I shipped this with my terms of 2% 10, net 30. Okay, if those were my terms and the invoice date was 9/6. Okay, and that's probably going to throw that to September or something. Okay, if my date is 9/6 and it's a $1,000 invoice and my terms are 2% 10 net 30, what date would I have to pay this by in order to take advantage of the 2% discount? Yep. We'd have to pay it by the 16th, right? Or on the 16th to get our 2% discount. How much would my 2% discount be? Yep, $20. Okay. So looking at the $3 million sale here, they would have received cash less their $60,000 discount. That's called a sales discount. And let's look just a minute at this sales discount account. If you recall, sales increase on, let me see if I can change this. I can't make it do what I want. Okay, here we go. My sales are revenues. Revenues increase on the credit side, right? My cash is an asset, increases on the debit side over here. Okay. What is this sales discount? Why would a sales discount increase on the debit side? When I have a sales discount, why would it be on the debit side? What classification of account would that be? Did anybody pick that up in the reading? Asset? Okay. My headset's not cooperating, I suppose. I checked all my connections again, so hopefully that helps. Okay, it's actually a contra sales account or contra revenue account. Do you know what contra mean? It's always fine to guess. When I ask a question, I would much rather you guess. Yes, it is. It means opposite or against or offsets. And so this sales discount will offset your sales to get to net sales. So you will have your gross sales less your sales discounts less your sales returns and allowances to get to net sales on your income statement. So we're going to throw in a couple more contra accounts as we move forward. And so again, it's sales discount and sales returns and allowances are contra revenue accounts. They offset your sales to reduce them. So now we're going to look at the sales returns and allowance, the other contra account, and this would be we received merchandise that wasn't satisfactory or it was damaged and we were returning it, and it would reduce the amount that we owe or that is owed to us. We're not returning it. Our customer returned it to us, and then they owe us less. This is getting more to the meat of the chapter, the things that are a little bit harder to understand and that we'll use Excel a little bit with to try to get a better feel for it. But we have many types of receivables. We have third, they're the third most liquid asset. They're after cash and our current investments. They have monetary claims against others. They are mainly acquired by selling goods. That would be your accounts receivables. And if we lend money to other folks, it would be a notes receivable. We have control accounts. We have to be able to record our receivables. We have accounts receivable. Here we have an example of a notes receivable. Both of these people owe us money. Sometimes you'll see accounts receivable called trade receivables. That's an important thing to remember when the book or My Accounting Lab throws you a different terminology. The accounts receivable is a control account. The accounts receivable account you've been using and been seeing on your balance sheet, that's a control account that is the total of all of your customers' receivables. And we keep a subsidiary ledger with a separate account for each customer. Here's an example of a subsidiary ledger. If we had a company named Brown, a company named FedEx, and a company named Moody's, and together they owe us the $9,000, we would still track each time. So if Brown paid us $200, then we would reduce both accounts receivables by $200 and the Brown amount by $200. In computerized accounting, that's just one entry. You pick which customer is paying you, and that happens. If we're doing a manual accounting system, you have to actually post that physically in two different places. A note receivable is a written promise to pay. It has to have a date. Do small companies keep... Okay, I have a question. Do small businesses keep a subsidiary ledger for each personal customer, or is this for only big businesses selling to resellers? If you have receivables, you better keep track of who each individual person is that owes you money. Otherwise, how are you going to know when everyone or who owes you? If you don't keep track of it, how are you going to know who owes you? Bottom line. And what if they get wind of the fact that you're not tracking who owes them money? Then they'll just think, well, why should I pay? Because they'll never know if it's me or somebody else. So if you are doing accrual basis accounting, you have an accounts receivables on the books, right? Then we need to, but does it go on my account? Okay. Okay, we have Amanda does receivables at her job now, And you keep subsidiary ledgers, right? You know which customers owe you what, right, Amanda? Okay. And in a computerized system, it's just not a big deal at all. You just, but you do need to know. And do I keep, okay, does it have to go on my accounting pages forms? Yeah, well, you know, it never shows on my balance sheet. All that shows on my balance sheet are my control accounts. So I only have accounts receivable on my balance sheet that would be shared with the public. Even if I'm a small business and I need to go to the bank, they're not going to know who owes me. They're just going to know how much all of my customers owe me with my accounts receivable. So yes, you're going to need to keep the subsidiary ledgers. If you're doing a manual system, then yes, you're going to have to keep a ledger for each one of your customers and keep track of exactly what they owe you and every time they make a payment. And as we move forward, oh, it turned on. Huh? So we have light bulbs going on in people's heads. I wish you guys could see the questions because it's pretty good, that some of the comments we get here. But anyway, it's, you know, it makes sense. It makes perfect sense. You keep subsidiary ledgers for lots of things. You keep subsidiary ledgers for your accounts payable because you want to know who you owe what. You keep not necessarily called subsidiary ledgers, but you keep separate ledgers for your different pieces of equipment that you have, because on our balance sheet it just shows equipment, but we might have 50 different pieces of equipment that we bought at different times, and we have to know what the depreciation is on each item and what their carrying value is in case we sell them. And so when you start thinking about it, you're going to, I mean, it does make sense that you have to have more detail than what we've talked about in the first 4 chapters of this book in order to keep good accounting records. A notes receivable is a written promise to pay. It's a definite sum of money plus interest. There's a maturity date, and you may have, it may be secure. If they don't pay you, you get some asset in its place. There are also miscellaneous receivables. You accrue interest on any money you have in a savings account earning interest, and that is interest receivable. And some companies will give advances to their employees, and so those receivables would be due back to them as well. We talked a lot about cash controls in Chapter 4. We also want to talk about making sure we keep our cash handling and our cash accounting duties separate. We should not let our bookkeeper handle cash. Amanda, do you handle any cash? If you can hear me, do you handle any cash? Okay, and you shouldn't, right? Because you're in the office and doing receivables, and you shouldn't have access to the cash, because you could say a customer hadn't paid you and you keep the cash. Melinda does handle cash. Do you do receivables too? Melinda, do you do receivables in your job? Okay. You work for a small company? Wow, really? So you work in a government office and they don't? Yeah. It's okay to handle the checks because those are trackable. But yeah, that's interesting, Melinda, that you work for the government and you have access to receivables and cash both. But I assume it's a small office and there's not enough people to do separation of duties. Yeah, that happens a lot. You see it in governments, you see it in nonprofits and small businesses where people just have to do more than one aspect of the accounting position. So that's why it's so important for even folks who don't plan to be accountants to have a good handle on how accounting works so they can at least look at their financials and see if something seems off to them. And that's, if you don't understand accounting at all, it's just really scary to hire someone to handle your money for you and your financial piece for you. So again, we were just looking at some separate internal controls, not anything that we don't all already have a handle on, I think, from Chapter 4. Some of the things that we might want to talk about too is it smart to issue credit to our customers, and how do we know how strict we need to be on that credit? We run credit checks. Should we have a credit policy where we determine based on their credit score what how much we will loan them, or if we'll even extend credit to them at all? And again, we keep coming back to have separate duties and a good internal control system. And we need to keep a good eye on customer payment habits. You should always follow up quickly, sending statements to slow-paying customers. Okay. One of the things that I always like to talk about some is when you're extending credit for receivables purposes, if you have a really good collection rate, like you just have no bad debt at all, then you're probably missing out on sales because you're not extending credit to enough customers that may have a little risk. And if you lowered your standards of who you would extend credit to just a little bit, you might be able to net more in the long run. You would probably have some more bad debt than you would, but you would also have more sales. So you need to watch that if you're in the business of selling, that you do need to take a little risk. As they say, no risk, no gain. So if we want to sell on credit, it usually helps sales and profits increase. Sometimes the customers cannot collect from their customers, and if they can't, this is recorded as an uncollectible account expense. An uncollectible account expense, of course, appears on the income statement and reduces your net income. Okay, and then we use the allowance method to record the losses based on the company's collection experience, and there's going to be methods, and this is what becomes more confusing. We record the uncollectible accounts expense on the income statement, as I said, and then we set up an allowance for uncollectible accounts. Here's another contra account. It's contra to accounts receivable. It lets us show the amount of receivables the business expects not to collect. This is just another one of the estimates. Again, as I like to say, we like to believe accounting is totally black and white, and it is not totally black and white. There's lots and lots of estimates, and the allowance for doubtful accounts is basically our best guess based on experience of how much we need to expense off each month to make up for the amounts we're not going to collect somewhere in the future. The way it would be shown on the balance sheet, we're going to show it right below our accounts receivable to show a net receivables of $475. You'll hear this called at times a net realizable receivables, the amount we think we can realize or actually collect. Here's another way that you can show the same thing. And our two basic methods, this is where it gets fun. We have the percentage of sales method and the aging of receivables method. The percentage of sales method is known as the income statement approach because we base it off the percentage of credit sales. The aging of receivables is the balance sheet approach because that is based on actually looking at all of our invoices, their due dates, and dollar amounts, and then based on again, experience percentage, multiplying that across to see how much we need to charge. So as I just said, we have our estimate percentage times our sales revenue equals the uncollectible account. Let me note again that the sales revenue is actually the credit sales if I had part cash sales and part credit sales. So watch for this on your assignments. They might say that they had 100,000 in sales and 10,000 of that was collected in cash. At that point in time, you only need to take your percent times your 90,000 because cash is already collected. You know you're going to get your cash, so you don't need to estimate what amount of cash you're not going to get. So here's an example. We have their accounts receivables for Apple for 11028, and currently they have allowance for uncollectible accounts of $10 here. Okay. Again, we notice that accounts receivable is our asset, increases on the debit side. Allowance for uncollectible accounts, it's a contra asset account. It is contra to accounts receivable. Therefore, it would increase on the credit side. If the credit department estimates that the uncollectible accounts expense is 0.0005 or 1/20th of 1% of total revenues, which are 1 million or whatever, 156,508 million, the entry that records the uncollectible accounts expense for the year also updates the allowance as follows. Okay, how much do you think that entry is going to be? Does anybody have a calculator that you can multiply this out? Okay, somebody's got a calculator. Okay, I have some amounts coming in. Okay, 78. It's actually 78 million, 78.29. So I have some interesting decimal point things going on here in your calculations, but it's something you really have to, yep. So that's, somebody said, yeah, they missed a zero. It's something you have to be really careful for or with, because lots of times you may see, they'll say 0.5%, and so then students will go out and put the 0.00 or 0.05, and that's not 0.5%. And so you have to make sure, or I'll say 0.5%, and so you have to put 0.005. So you have to make sure that you get your decimal point in the right place. So our entry is going to be nothing. I'm making things yellow. Uncollectible accounts expense and allowance for uncollectible accounts. And that is actually an adjusting entry. It's an adjusting entry that you do at the end of every period before you prepare your financial statements, just like we adjust for supplies. Here's our posting. Allowance for uncollectible accounts is our balance sheet account. Uncollectible accounts expense will appear as an expense on our income statement, and our net receivables are $10,940, the 11,028 minus the 78. We now have a balance in allowance for doubtful accounts. Here's what I want you to notice about this method. Notice that this was our beginning balance, right? We computed, remember we computed our math on the previous slide. We computed and we came up with the 78, right? And that is the amount that our entry was, 78. And so we end up with a new balance of 88. Okay, the $10 is the balance that we already had. The $10 is a balance in our account. At the beginning of this period, we had a balance of $10. And it didn't really say that anywhere, but when we click on this next slide, that was already in. The $10 was in as the beginning balance. Does that help if we know that's beginning balance? Okay, so that's our, and that's what really plays into the difference in the two methods too. So it's important that you ask that and understand that we have a beginning balance of $10. If I had a beginning balance of $10 on the debit side, which can happen if I didn't estimate enough uncollectible accounts when I did my estimate, then in this case, my entry would have still been $78. Now that's important too to know. It doesn't matter what my beginning balance is. I use the amount that I calculate in my formula in my percentage of sales entry. When I'm using the aging, I'm using the estimate percentage of uncollectibles times my account receivable to get my allowance for uncollectible accounts. So this method is a little different. We are going to start, we have the same accounts receivable. Nothing's changed there. We have the same beginning balance. Nothing's changed there. It tells us that our aging shows that the company will not collect $98,000. Okay. Now this is based on an aging, which we will look at later, but because it's based on an aging, this is what we need the balance of our account to end up being. We need our balance to be $98. So what amount do I need to credit into this account to get the balance to be $98? Can anybody tell me that? How do I get from $10 to $98? $88. People are saying $88. Okay. So here's an example of an aging. We would say all of our different customers. We would look at all of their invoices. If Walmart had some that were 1 to 30 days, some that were 31 to 60, some to 61 to 90, and some over 90, we would list the dollar value of those invoices under each column. For each customer, we get our total at the bottom for that, and then this is the column that's based on our experience of what we have not been able to collect as an invoice gets older. Okay, and then we multiply that times the percent, in this case the 10,164 times the 0.75, which you would have to put 2 zeros, right? And get 76. And same thing for each column. And that's how we got the $98. Okay. So our entry is the $98 or the $88, as you said, because our balance again has to end with the 98. So that's the main difference between the two methods. The percentage of sales, you multiply it times the sales they give you, and that's the number you use. And when you're using the aging of receivables, you have to make the balance in the allowance for uncollectible accounts be the amount. So what if in this case, what if I had $10 on the debit side to start with? How would I get this amount to $98? What amount would I use? Instead of 88, what would I use if this was 10 on the debit side? Yep. Hey, you guys are getting this. Very good. Yep. 108. Now you're on a roll. So just don't forget, and you'll be fine on that the methods are different. Then when we go to write off a bad debt, we just write it out of the allowance account. Once we are notified that we're not going to get that debt, it comes out of the allowance account, not out of the actual, we don't actually just expense it. Then we've already designated the dollar amount that we are not going to collect that matches up with that revenue. We just don't know who's not going to pay us yet. So here's where we were notified that we're not going to get a collection from RS. And so we just said, okay, that's 9 of the 98,000 I'm not going to collect. I'm just going to write it out. It does not change my assets at all. My liabilities, stockholders' equity, my net assets stayed exactly the same. That's a question they ask you a lot of times. Okay. Now, the company, we show that they don't owe us anything. We wrote it off as a bad debt. It's just a quick example. Okay. And see, this is what's always interesting. I mean, it is interesting that it doesn't change your net receivables at all. But you'll notice it doesn't. When you write off a bad debt using the allowance method, your receivables stay the same. So what's the difference in these methods? The percentage of sale adjusts the allowance for uncollectible accounts by the amount of the uncollectible accounts expense. And the balance sheet approach, or aging of receivables, uses the uncollectible accounts receivable. So it's just using a little different approach is all. And either one's fine. Some companies even will do the percentage of sales until their year end, and at their year end they'll do an aging, and that keeps them within scope and material, and there's a lot of cost benefit to that because a percentage of sales is much less time consuming than a aging of receivables. I'm going to just click through this. Okay. And this is just their adjusting entry. It's the whole process. And I know I'm clicking faster than you can read, but I'll post these. There is the direct write-off method. The problem with the direct write-off method is it is not GAAP. So if you are a publicly traded company, you have to comply with GAAP. I would recommend everyone complies with GAAP. But it doesn't match your revenues and your expenses within the same period, because I could have a sale today. I might sell something to a customer for $10,000, and then 1 month goes by and they don't pay me, the next month goes by and they don't pay me, the next month goes by and they don't pay me, and I'm still, they're still on the books, but I recorded the revenue 3 months earlier. When that first month when I invoiced them, I recorded that revenue. So I already didn't match that expense with that month, and then maybe 6 months out, my policy tells me that if I haven't collected, I write it off as a bad debt. So 6 months later, I write off that expense. I have to write off that, well, my customer didn't pay me, so my income was actually overstated by $10,000 in the month that I recorded the revenue, and then it was understated in the month that I did the expense. And, it's just not great. However, for tax purposes, just because we want to keep the world exciting, we do have to write off direct write-off method. So if I have bad debts, I have to adjust for that write-off when I'm doing my income taxes. So okay, here we're writing it off. So this is just showing us how I can use my T accounts to compute how much money I collected from my customers. If I had a beginning balance and I had sales on account and I knew I had written off $100 or thousands, whatever we're doing here, millions, I think, then how do I calculate how much I get? It's the 18 plus the 200 minus the 100. Okay, I was reading my questions and seeing what I needed to try to get to. Okay. The end of the chapter talks about notes a little bit. So, of course, we've got some terminology: the creditors, the debtors, the interest, maturity date, maturity value, and the principal and the term. And the term is the length of time. You're going to have a written promise to know. It's called a promissory note. It must have a date. There's certain items you must have. You must have a date. You must have an amount. You have to have when it's due, a date it's due, or it can be just, it could say 30 days or 90 days or 60 days, whatever it is, and then it should be signed. Do you have to have a formal note, or can you write it just on a plain piece of paper if you need to take it to court? I said, do you have to have a formal form or a formal note, or can you just write that on a plain piece of notebook paper as long as you have all of the proper information on it? You're right. You don't have to have a formal form or a formal note. You just have to make sure that you have the information. It can be written on any old piece of notebook paper or the back of any paper, as long as you have the date, the principal, the interest rate, the terms of that note, and a signature. You're good to go. We record a note just as a note receivable, and we loan to cash. It accrues interest, the basic principal times interest times time. Depending on how they do the terms of the note in your problems, it's helpful at times to know how many days are in a month. You can always use a calendar, but it's also nice to just learn that. This happens to be 4/12 of the year, so they must say it's 4 months. They didn't give days. So this is an interest receivable. They're not currently collecting the interest, but they are going to record the revenue because it was earned in this period. They're collecting the note. They get the cash back, zero out the note receivable and the interest receivable. And problem is, we don't balance, do we? We don't have debits equal credits. That's because we need to record the rest of our interest revenue for the period. So interest rates are usually expressed as an annual percent. You use a fraction for times period. You either use the number of months divided by 12 or the number of days divided by 365. And there's a way to shorten the credit cycle. We can use the sales discounts. We can encourage folks to pay by saying we'll give you a 2% discount if paid within 10 days. And it's really beneficial to the companies to take advantage of that. It's a huge percentage of saving on your money. We can charge interest to past due customers. We can have good credit and collection procedures, and we can emphasize credit card and bank card sales. Those are guaranteed. We have to enter a credit card sale fee. If we have to pay 2% to the bank to have that credit card, then we're going to record our cash, our credit card discount that we have to pay to the bank, and then record our sales revenue. So it does cost us to let our customers use credit cards, but we know we have our money. You can also sell your receivables to raise money. That's called factoring. We might sell it to a different collection agency. We might sell them to the bank. If we don't have great credit history, we might sell them to increase our cash flow. And it's just a way to raise cash fast if you need cash. You can sell with or without recourse. If I sell my receivables to you without recourse, you're not going to pay me as much for them, because that means if something's bad, if somebody doesn't pay you, you can't come back to me. If I sell them to you with recourse, then if I sell you a bad debt, you can turn it back over to me and I have to pay you for it. And we'll take a quick look at these two ratios, and then we'll have a little time for questions. Quick asset test ratio, it's like the current ratio, only we just have the really quick convertible assets listed in it. The higher the ratio, the easier it is to pay your current liabilities. Okay. You would always look at your industry standards to determine if it's a good ratio for that company. And then our days and receivables is just a couple of steps here. We need to get our average daily sales. That's your total sales divided by 365. That's going to give me my average daily sale. My days in receivables then will be my average receivables. That's my beginning receivables, or my balance sheet amount at the end of the previous year and my balance sheet amount at the end of this year, divided by 2 to get my average, divided by my average sales will get me my days in receivables. So to compute the acid test, just as a quick example here, we would look at our cash plus our marketable securities plus our accounts receivables and divide those by our total current liabilities. So we would have to use just current. So these are the currents, right? So we would add these assets and divide them by these liabilities to get our quick or acid test ratio. And that's a fairly weak current ratio or acid test ratio. Our days in sales. Okay, let me go back here a minute. Here's where I said we would be able to look at our beginning and ending receivables, add them together and divide them by 2. So our receivables are 31.6 days, and that's not too bad when we have credit terms of net 30. Okay, I'm going to go, I would think you wouldn't have to, okay. I'll go ahead and open up the mics if you want to try to ask any questions. Okay, open the mics if you have anything you want to ask. Or you can type it in. Shad's good, it says. Okay, everybody needs to remember that you can send me questions, preferably using the discussion board questions. You can pop me off an email as well, especially if I don't get back with you really fast on that. I try to check that every day. I do confess that there are days that I don't get it checked. So Melinda's good till she starts the homework. Well, remember to use the ask my instructor in my homework in your homework too. I know there's a couple of things in there that I have a couple classes that I teach for another college that are ahead of you guys, and And I know there was something in their assignment that tripped them up. It was just a little confusing. So if you get to something that seems like you don't understand, just be working far enough ahead to ask. Yeah, Melinda likes to just keep reworking her problems. And that's fine as long as you're asking yourself. Bailey, yes, I can email you that. Did you like that spreadsheet? Let me write down this address. B. Ramsey. 6. Okay. Okay. So, okay, Bailey, I'll email you the sheet. Whose class are you in? Do you know what region are you from? Ah, okay, good, Kokomo. So anyway, the redoing with the My Accounting Lab and the taking all of your chances, and I hope you do all realize that you can retry your practice forever practically and try a similar problem until you get all your points. But my main thing, and I know you do a really good job, Melinda, with it, but my main thing is that if you do it enough times, you can figure out which numbers they're adding together. And I just want to make sure if you still don't know why, it's those numbers that you're asking the questions. If you figure out, oh, I see, I understand the concept of why it's that now, that's fine. But if you say, okay, I can look at it enough that I can figure out how to get the right answer, but I still have no idea why, then I need to have that question asked to me so we can get that clarified. I will post this, Amanda. I will post it in your class, and then it will eventually end up at that link where I showed you earlier, that the ivytech.edu link. It will be there once they do it through central office. I have to send it, put it in a Dropbox. They have to retrieve it, and then they will upload it to YouTube, and there will be a link there to go to YouTube, and it may play back nicer and more than it does on yours. I fight with playing them back on different computers. I had to download a different movie player to do it on instead of just the Windows player, but it seems like every computer I try to open it on, I have to do something different with.